As the White House looks to roll back regulations, what is the fate of the new fiduciary rule? We'll have a guest to provide the latest. Plus, we'll explore a growing investment strategy known as impact investing. This is 7-Day Yield.
Welcome to 7-Day Yield. I'm Lydia Moorish.
And I'm Mitch Rochelle. Later on today's program, we'll explore a new growing trend in impact investing.
But first, we've talked a lot about the Department of Labor's fiduciary rule. With its effective date approaching and the White House's deregulation agenda, will the rule ever get implemented?
To get the latest, I recently sat down with our own Arjun Saxena. Take a listen. Arjun, the DOL's fiduciary rule is still grabbing a lot of headlines, so why don't you start by explaining the state of play of the implementation and rollout of the DOL rule?
The implementation date, which was previously April 10th, is now June 9th, 2017 for the first round of changes, and the implementation date for the January 1, 2018 date still stands as is. There's a flurry of activity that's continuing to try and meet that implementation deadline against a whole host of changes on the product side, pricing, client segmentation, advisor compensation, so on and so forth.
So maybe you could sort of take us through how far-reaching the ecosystem is of those impacted, because I don't think the audience may really appreciate how wide it is.
Sure, absolutely. So, the rule directly impacts anybody who is giving advice to retirement account holders. Wealth managers, the asset managers who design retail products, so mutual funds, for example, or various kinds of UITs and so on and so forth, all would be impacted indirectly by this regulation. And then certainly insurance annuities manufacturers, because those products again are sold and serviced by financial advisors, right, will also be impacted.
But sticking with the insurance example, insurance product is often sold through independent agents. Does that translate all the way down to the independent agent, and they have to act in accordance with a 1,000-page rule that they may not understand?
It does. So for better or for worse, that is indeed the kind of intent of the rule. It's more onerous for an individual provider or some of the smaller distributors or wealth managers, and the result that they are certainly leaning on some of their providers. So many of them end up working with a Fidelity Clearing or a Pershing or some of the other providers for clearing, custody, platform services to help them comply with the rule. And there is also some degree of consolidation underway as some of the smaller providers decide that it's not worth their while investing in the systems, the changes that will need to be made, and they are probably better off selling and getting rolled into a larger provider.
When you think about a June deadline for implementation with not a lot of runway, if you're not doing something right now and you're in that group that you mentioned, yep, what should they be doing right now?
Clearly, there's only very limited time available till June 9th. Now, what the DOL has clarified on more than one occasion is that they're not looking to come out on June 10th with a compliance view or trying to find fault, trying to find where you've messed up. They want to try and be helpful, which is why there's the June 9th deadline, but then also the January 1, 2018 deadline. So for those who feel that they're somewhat unprepared, the DOL has offered to clarify, to really help them get prepared. And I would certainly urge those clients to take up the DOL on that offer and hopefully get there, if not by June 9th, then certainly by January 1st.
Well, member of the 7-Day Yield team, Dr. Alexis Crow, is here to help us explore the implications of deregulation. Welcome back to the show, Alexis.
Thanks so much, Lydia.
So obviously Arjun focused on deregulation within the financial services space, but are we seeing this more broadly in other industries in the U.S.?
We are indeed. We're seeing it across the oil and gas industry in the United States, particularly in regard to shale drillings. The United States has an abundance of this difficult to penetrate rock. Now, President Trump has promised this repeal of regulation across the shale industry. Now, in contrast to a lot of the oil field majors, the major oil and gas companies, shale drillers, there are about 1,500 independent shale drillers across the United States, and they can quickly shift it on and off. And so with this ability to do so, we're seeing all of a sudden an abundance of shale energy being produced, and therefore there's a glut on prices, and it's further contributing to this glut on supply.
Interesting.
So I think of that as potentially a disruptor. I don't think of anything in the oil and gas industry as being disruptive. But when you think about the economy, in as much as you're an economist, would more supply of oil sort of prevent a run-up in oil prices, which could be a drag on the economy? So this is a good thing long-term, not only for our economy, but for perhaps the global economy?
Well, you have to think about the profitability of these companies. I mean, look at human behavior. If you all of a sudden remove regulation, we hoard and we go, in droves. And so that's exactly what's happening in the shale industry. So you're pushing prices down, so you're contributing to this already glut in supply. So over the longer term, it's not necessarily recommended behavior for corporate profitability.
Energy independence, though, is also one of the campaign promises. So
this is the allure of being an American president. It is absolutely irresistible to touch this wand of energy independence.
Well, thanks, Alexis. Stay right there. We'll have more questions for you in a moment. Investing with the goal of purpose and not simply profit is a rapidly growing trend. Mitch dug into the topic with PwC's Don Reed. Take a listen.
Don, the broad category of impact investing means a lot of different things to different people. So maybe you could sort of put the parameters around what impact investing really is.
Sure. At the highest level, Mitch, it's really investing with the intention of getting environmental and/or social benefits. And that doesn't really make reference to the asset class. It can be in any different asset class. But the real key thing to unpackage with it is, are you getting risk-adjusted returns that are commensurate with the returns in that asset class?
Is it possible that investors would accept a lower return because they felt that they were sort of doing good and there was a philanthropic slice, if you will, to what their yield expectations were?
Sure. There are some investors who want to do that. And we particularly see growth in family offices that are doing that very specifically and really building out the capacity.
I want a 9, but I'll take a 7 because we're doing good.
Right. Or I want a 7 and I want to get a 7, but I'm willing to take more risk than others would in the same sort of situation.
Got it. So we've talked about what. Let's talk about who for a second. So you mentioned family offices briefly, but who are some of the players that are allocating capital towards impact investing?
Right. Well, I think that the first branch in that logic is when you have risk-adjusted returns commensurate with everything else in the asset class, you really open the doors to institutional investors with a strict set of fiduciary duties saying, okay, I can do this side by side with my fiduciary duty. But where we're really seeing much of the growth is in family offices that do have more capital, and increasingly as the billionaires and millionaires of the digital age get into investing those assets, saying, well, oh, can I have impact in my portfolio? And hey, maybe I can do that across asset classes.
Infrastructure is a word that, and I contend that if we did a word cloud of the of the number of times the word was used, infrastructure would be not only a long word, but a big one. Maybe you can elaborate on where we've seen some infrastructure plays, schools, hospitals as an example, where impact investing's playing out.
Some of the leading infrastructure categories in impact investing have been around power generation, for example.
So lots of more clean.
Yeah, clean energy and distribution, and in some cases even energy efficiency. For primary infrastructure, when you think about roads, bridges, that kind of infrastructure, what we're seeing really is impact focus in emerging markets where there isn't municipal or state and local ability to pay for that. Certainly here in the United States, we have yet to see what a new infrastructure approach might look like. Public-private partnerships, those kinds of things could easily give rise to new opportunities to do impact investing in infrastructure in the United States, but that's less of a category right now.
Has the assets under management grown dramatically over the last several years?
Well, all the indications are that there are more vehicles to do that. They're covering more asset classes and they're growing nicely. And you see some large asset managers who heretofore really hadn't been playing in that space with new offerings. So very large publicly traded equities managers, as well as we're seeing a handful of the really big private equity investors form impact funds.
Welcome back, Alexis. So the impact investing category is pretty broad, but I'm hoping you could characterize sort of the state of that world for us right now.
We're seeing a lot of companies and investors shift into what's called ESG criteria, so the environmental, social, governance criteria. These are kind of criteria that are evolving out of the UN Sustainable Development Goals, the SDGs, around looking at business ethics, carbon emissions as a way of measuring companies' performance.
Are those global goals?
They are global, so the UN Sustainable Development Goals. There's been, however, a large push towards compliance with the COP21 goals, for example, in the 2015 Paris Climate Change Conference, and reducing carbon emissions and climate change and global warming to 2C. And so we're seeing a lot of the world's major oil companies, for example, saying that they're going to shift into 2C. We're seeing a lot of investors, family office, millennials shifting into ESGs, and even large Fortune 50 companies starting to consider how they can incorporate the criteria in their own business and operations.
And I know Lydia's chomping to ask a question, but I'm fascinated. Is this society sort of changing the way it views its investing priorities, or did these rules or goals sort of change the behavior? So what came first?
Well, so regulation is of course an impact, but I think if we look at really investor preference over time and even looking at returns, the MSCI indices have actually pulled together an integration with ESG criteria and are monitoring companies that look at ESG criteria, and it's evident as of late last year that a lot of these companies are outperforming those that do not involve ESG criteria. So even if we're just looking at returns and performance, managing risk, but preferentially looking at investors, really the millennials, even women are focusing on pivoting into ESG and social impact investing. And this has large implications as we see this large shift of wealth from the current baby boomers that are transitioning into their children who are, millennials who will be managing this wealth.
I was going to say you touched on a lot of different things there, and my mind is kind of racing because for one, I think a lot of people sort of stayed away from ESG investing before because they thought they would be sacrificing returns. Now we see this big push that millennials are going to be, intergenerational wealth transfer over the next 30 years. So are we going to see a big influx there? But I read this really cool quote that it's not so much about changing the world, but it's more about understanding the world is changing around us. So how does that resonate with you?
This is, predominantly a shift out of necessity. If we look to countries such as China, and they're shifting out of coal because they have to for their people. So the IFC, the investment arm of the World Bank, has estimated that there's about $23 trillion worth of projects in green and sustainable finance in the next 15 years in emerging markets, particularly developing Asia, and the bulk of that being in China. Why? Because it needs to be done. In the United States, for example, we still subsidize fuel. Right? So it's an issue in the United States, it's an issue currently in Washington, but that doesn't mean that it's not top of mind for current investors.
Right.
Interesting. Unfortunately, we're going to have to leave it there, but you are always welcome back on 7-Day Yield. And thank you all for watching. Your feedback's fantastic, so keep it coming.
We have some great topics coming up in the next few weeks, so be sure to check out our PwC YouTube page for all the latest episodes. We'll see you next time on 7-Day Yield.